Anti-dilution is a protection for investors that protects their ownership percentage if certain events happen. There are a few primary anti-dilution provisions that appear in early-stage equity transactions. This video will cover the most commonly used and company-friendly formula for early-stage rounds of equity funding. Broad-based weighted average anti-dilution occurs in the event of a down round of equity raise that represents a smaller increase in the conversion rate of preferred stock based on the number of shares sold relative to the existing stock, as well as the difference in the price. Let's go through this step by step. This calculation adjusts the conversion rate using the original issue price of the shares sold in the previous round. This is the formula that appears in preferred stock transaction term sheets, the calculation used for broad-based weighted average. This is more favorable to the company because it provides for a smaller conversion ratio when converting preferred stock to common stock. Here is what each portion of the calculation represents. To figure the new conversion price, we need the conversion price of the prior round, the fully diluted capitalization number, the total amount to be sold in the new down round, and the total shares sold in the new round. Let's break this down a little bit more. Here is our company cap table just prior to our new capital raise. We are planning on raising $500,000 in this round at $1 per share. Investor A, our previous investor, paid $2 per share, so this is a down round, and Investor A is allocated anti-dilution protection. Here's our formula, so let's plug in the numbers. CP2, well, that's what we need to figure out. CP1 is Investor A's price per share of $2. A is equal to the fully diluted capitalization just prior to the round, not taking into account any securities that may convert into this new down round. That number is $1 million. B is equal to the total amount to be raised in the new down round divided by Investor A's price per share. So 500,000 divided by 2 is equal to 250,000. Then C is equal to the number of shares issued in the down round. 500,000 shares. Here, we plug the numbers in our formula. CP1, which is 2 multiplied by A plus B, which is 1,250,000, divided by A plus C, which is 1,500,000, equals 1.67. Conversion price 2, or CP2. There's just one more step. Now let's figure our new conversion ratio. To figure our new conversion ratio, we take the new conversion price of 1.67 and divide it into the early investor's price per share. This is the rate at which preferred stock converts to common stock because of this new down round. The conversion ratio is the number of common shares received at the time of conversion. The higher the ratio, the higher number of common shares received. Why would I want to negotiate anti-dilution into my term sheet? The main reasons to provide for anti-dilution in your equity round is that it attracts investors and protects their equity position, which makes them more likely to invest down the road. If you don't offer anti-dilution in your early rounds, you may have difficulty finding investors.